Welcome in, folks. Got a 5-piece to react to in this one. 5 different little video clips I need to react to here today. A lot happening in the stock market, a lot of big moves. We got to talk about where things are headed from here. First one up here, SoFi's Liz Young. I'm more bullish on software than semis in 2025. That's going to be an interesting one to react to, and the reason being is I own some software companies, and I also am buying heavily what right now? I'm buying AMD heavily right now. So if AMD is not a good play in 2025, we're going to speak about that. I think that's going to be an interesting conversation, right? Why 2025 could be another year for growth for stocks, so that's going to be an interesting one to react to. Goldman Sachs' Elizabeth Burton says next year should be about growth assets and diversifiers. That should be an interesting one to react to. This one's pretty crazy. Pretty easy for S&P to reach 7,000 by year-end 2025. That's a bullish call, so looking forward to reacting to that one. And then last one up here to react to, tech is facing a very high bar in the near term, says this gentleman, so I want to react to that one, share my opinions and perspectives there. By the way, appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for smashing that thumbs up button, and thank you for being subscribed to the channel. New all-time high subscribers in the history of the channel. Appreciate each and every one of you for being here always. And let's have some fun. Let's get into these guys. Let's react.
Angela Mwanza and BMO Capital Markets, Brian Belsky. It's great to have everybody with us. Angela, I'll start with you. Just to segue off of what we were talking about with tech. I suggested that this space has woken up lately. You still like it into the new year?
I still like it into the new year, and I'd say, Scott, the question we're getting from clients the most when they see numbers like this is, are we looking at an overvaluation? Is it time to take money off the table? Is this a risky situation that they're finding themselves in? I think the question there has to be, it's a high evaluation, but does that mean it's actually overvalued? And for us, when we look at mega cap tech names...
Hold on for a moment. Let me answer this question. Is it time to take some profits? Listen, there's no shame in the game. You made a fortune last 2 years in certain stocks, and you feel like their valuations aren't super attractive anymore, and you feel like it's going to be harder to get gains in those stocks based upon where their forward Ps are at, versus where their net income's going over the next few years, take some profits. No shame in that game. I've taken some profits here recently in the fourth quarter on a couple different stocks, right? Respect. Nothing wrong with that. And then if you want to deploy that money somewhere else, do it, right? There's a lot of stocks that I've held for many, many years that have now made me tremendous amounts of money, and I'm taking profits, and I'm redeploying that money into other opportunities I see in the market that I think are going to be much bigger opportunities, because not all stocks are going to be respected at the same exact time. There's certain unbelievable opportunities I spotted in the market 2 years ago, 3 years ago that I invested heavily into, right? And those stocks have obviously expanded their valuations massively. And now there's other stocks I'm looking at out there, and I'm like, this is a big opportunity, this is a big opportunity, this is a big opportunity. And you see me investing into those now at this point in time, right? So, yeah, don't ever feel shame, especially if you've been holding the stock for several years and you've made a fortune on it, and the valuation is at a place where it's like, it makes sense to take some profits here. Don't be ashamed of that. There's no problem with that. Where people have issues is some people buy a stock and a week later they're already trying to sell it. A day later, they're already trying to sell it. A month later, it's like, what are you doing, man? If you're making those short-term decisions, you're likely not doing enough research work before you go into there, or you don't really have confidence yet because you're super new to the market.
We want to rebalance out of it. We want to take away some concentration in the portfolio, but we still think that has legs. If you look at the last 6 months in the S&P 500, this Magnificent Seven has actually lagged the S&P 500. So you're seeing a broadening going on within the markets, which means for us it takes a little bit of risk out of the market and gives us more and more opportunity. And I think they're great other places to be investing as you trim some of your large cap, your mega cap tech names.
Liz, you've really had a tale of two tech groups. I mean. The meltdown, as we've been calling it, in momentum, which has encapsulated a lot of other high growth tech names, AppLovin, for example. These stocks that yesterday really rolled over hard. So you got to be careful in the way you talk about tech as a sector. Mega cap seems to be performing better. These things now, after a massive run, some of these stocks are up 900%, right, or the like year to date. Had a really tough day yesterday, and some are down again today.
Yeah, I mean, some of them, you look at the chart, even a 1-year chart, and try to convince yourself to buy after you see the line go from the bottom left to the upper right so strongly, it gets difficult. I'm going to steal a talking point from Mr. Belsky before he even gets to talk today. Some of these mega cap names are what people consider the new consumer staples, and that's something that I think people have looked to in periods like this, the month of December, month to date, we've seen this pretty big reversal in just factors, right? Momentum is performing poorly compared to how it had done earlier in the year.
I mean, it was doing great until yesterday. And then all of a sudden you had a rollover. Like I said, the Palantirs of the world, the AppLovin isn't down another 6% today. It was down huge yesterday. It feels like something's going on.
It's crazy to me. It's crazy to me in regards to Palantir specifically. This is wild, man. Like, it seems like it wasn't that long ago, like, Palantir almost never even got mentioned, right? And, like, to now hear it be, like, talked about on a regular basis when people are talking about Meta and talking about Google and these other stocks, right? And I hear Palantir, like, I have CNBC on while I'm working in the background all the time, right? And I'll be half listening and, like, I'll hear Palantir. And it's just crazy because it was like, you go back 2 years ago, who was talking about Palantir on CNBC 2 years ago? Give me a break, right? And, like, to see the change now, and it's like every day you're going to probably hear the name brought up on Bloomberg and CNBC several times a day, especially now that they're in the Nasdaq, going into the Qs, right? Or excuse me, now they're in the Nasdaq and the Qs, right? But also in the S&P 500, best performing stock in the S&P 500. So it's just wild how fast things can switch from just no one talks about it to all of a sudden it's like mainstream financial media.
And I think that there's a rotation of those factors. So it's not just momentum that's seeing it. Low volatility stocks not doing well in December compared to how they've done earlier in the year. And then you look at the other end of the spectrum and you've got things like growth and liquidity doing really well, and they didn't do so well for the first part of the year. So I think there's a rotation happening partly because we're at the end of the year. People are taking some profits. They're trying to reallocate their portfolios, getting ready for the new year. And because we had this big burst of optimism and this big burst of buying post-election that probably needed to cool off a little bit. So the beneficiaries of that are perhaps taking it on the chin a little. The other thing I would say, especially about tech, is it's not all going to be equal going into the new year. I think we'll have a similar story to what we had in 2024, where some of them are going to look great, some of them are going to look not so great, and you have to be choosy about it. I'm choosing to break up the universe into semiconductors versus software, and I'm much more bullish on software in 25.
Well, alrighty, much more bullish on software in 25. You know, I think that's kind of where a lot of people are at, right? More bullish on software. But I don't think you should necessarily cast away some of these semi stocks, especially if they keep going down, right? Obviously, I'm insanely bullish about AMD. I've talked about AMD a lot in the past week, specifically on the main channel. If you don't watch my main channel, Financial Education, type it into YouTube. You can watch some videos I put out recently. Several videos in the past week I've talked about AMD stock specifically, right? Even yesterday here on the Reaction channel, if I recall, I spoke about AMD stock, right? Incredible opportunity to be buying over this next, month or next few months here in regards to AMD, right? But even Nvidia now, if that one keeps going lower, like, I wouldn't throw away Nvidia either. I thought Nvidia might exit this year between 150 and 200, right? And probably closer to 200. And now it's looking like that's pretty unrealistic now at this point in time. Right now it's looking like who knows where it's going to exit the year. Maybe between 120 and 140. Maybe it exits the year, right? So that creates some potential, I think, upside next year for Nvidia. I don't like it nearly as much as AMD. I feel much better in AMD than Nvidia. But even that one, I'm like, there might actually be opportunity in Nvidia as well. So you could actually do a combo buy of buying Nvidia and buying AMD, right? So I wouldn't just give up on all the chip names. But I would say if you're gonna buy chip names, I would lean toward Nvidia. I would lean toward AMD in that sort of environment, right? Alright, next video up here. Why 2025 should be another year of growth for stocks.
With us is CNBC contributor and KKM Financial founder and ETF lord, Jeff Kilberg. It's great to see you both. Andres, just lay it out for us first as you're kind of going through your process for 2025. A lot of people think it's too good to be true. Next year's going to be a year of more mean reversion.
Yeah, I mean, the first thing I would point out is that average returns are actually rare. Wall Street's predicting 10% returns next year, as they usually do. There's only been 2 calendar years over the last 90 years in which you actually saw 10 to 12% returns. So the reality of it is that being up 20, being up 25 is more common than being up 10 or 12.
But would you say being down 20 is more common than being up 10 or 12?
Within one standard deviation, 68% chance that you're down 10. Okay. That's actually not uncommon.
Okay.
Right? But think about it this way. If directionally the market's...
Okay, year 3 after back-to-back annual 20% plus gains. So 1929, you had negative 12%. 1937, those old times, this is so irrelevant, right? Even back in the 50s, so irrelevant. 1997, 31%. But you know what's interesting is, actually, Andre inside my private stock group, he posted something. Andre's phenomenal. He helps me run the private group, right? He posted something that was very, very insightful in regards to what happens to the stock market indexes after a 2-year rally, especially a big 2-year rally like we had. And what he showed essentially was several different time periods after you had 2 major up years. And what you found is usually it was around a 5 to 7 year up cycle after you had 2 straight years of an up cycle. Don't just bank on like, oh, the next 3 years are going to be great as well. But a lot of times that is actually what happens when you get 2 sustained years where it's very good for the stock market overall. So just something to keep in mind, right? Like, as I've told you guys several times now on this channel, what is going to cause the next crash in the market? If you're thinking about what the next crash is going to be, outside of some black swan event that no one saw coming, right? Like some crazy blah, blah, blah happens. Once in a year health event like Rona happened, right? Outside of that, like where's the next crash come from in the market? The next crash comes from the next high inflationary cycle we have. There's a decent probability in the next 1 to 3 years we get another major upcycle in inflation, where CPI goes to 3.5%, 4%, 5%, right? I don't think we're going to go back to that 9% plus CPI again for a long, long time, maybe probably decades. But the next time we get a major cycle up to even the 4s, 5s, and 6s, it's going to cause a lot of damage to the economy, especially if job openings are not in a great place at that particular time. We got saved in the 2022 inflationary cycle because we went into 2022 with just an incredible amount of job openings, like all-time record highs we hit in 2021, right? Those have come down massively now. So now we're going to probably be even here for a bit, right? Probably not going to see a ton more job openings in the short term or shrinks. So we're probably going to be flatlining here for a bit. Now, whenever that next inflationary cycle comes, boom, that's when it's going to get nasty. But, I mean, that might still be 6, 12, 18, 24, 36, 48 months away. So keep that in mind.
Wow. There's no reason to think that 10% is where we're going to hit because historically that's actually been rare. If the markets go up, they tend to go up.
So interesting. So you think we could have a three-peat?
I think there's a better chance of having a three-peat for the market than for the Chiefs.
I said, why did you make that analogy? They look okay lately.
They look great. Mahomes looks great, but there's only happened twice where the Green Bay Packers in the 20s and the 60s had a three-peat. So that would be rare.
But the investment case has only happened once. So wouldn't it be based on history? This would be more unusual than that.
Well, there's been 4 times since the 20s in which the markets have been up 3 years in a row. So it would be 3 versus 4, meaning...
So maybe not up 20%, but up 3 years in a row.
Yes.
Jeff, would you like to bail us out here? Would you like to weigh in on the market versus Chiefs? Who's going to defy history?
Well, first and foremost, I want to weigh in on Michael Jordan and the Chicago Bulls and their three-peat in the 1990s. But I'm not as optimistic as Andres. I see your...
Yeah, if it's a Jordan situation, we're looking at likely another good year for the market in 25, and then a big off year for the market in 26. And then 27, 28, 29 would be good years if we're playing Chicago Bulls Michael Jordan, because remember, he took the year off in between.
Seems like the market is stuck on automatic. We've seen massive inflows, week after week, historic inflows ever since the November 5th election. And those expectations we have for 2025, I think have been pulled forward. So when I look at complacency presented in the VIX, when I look at the kind of exhaustion we're seeing with NVIDIA moving a little bit lower, I get a little concerned short term that we have the ability to have another 25% plus year. I'm cautiously optimistic, but I see a single digit year with the 10-year note back at 4.25 and all the moving parts. I think the expectations for the market cap growth stocks, the Mag 7, to continue to lead the way, I just don't see that happening. And then we talk about the outliers, the Palantir, we talk about the Tesla, we talk about the MicroStrategies. I think that's a bit of a distraction. I think we're going to get back to basics next year in some of these blue chip industrial names, which should profit under the Trump 2.0.
See, that sounds sensible to me, which is why I think Andres might be right. Jeff, don't you think the sensible thing never happens? The sensible thing never happens.
Oh, for sure. And look at this year, Kelly, when you see the estimates, every S&P analyst had estimates. They were 25% wrong. Their targets on average were about 4,800 in the S&P 500. And here we are at 6,100. I think you're right. And I think every move we've seen as investors and traders, we've become conditioned, we've become acclimated. Today, we're seeing the S&P 500 with a very narrow range. It feels like a down day because we haven't had a new record all-time high. So I think you're absolutely right. The moves up and down will be exaggerated, but I think that is going to happen when you see more of the Fed pull back their $7 trillion balance sheet. But I don't know if that happens in 2025, and that plays into the fact that Andres may get his three-peat.
Jeff, let me put it differently. So you're an investor.
You guys know the group of stocks that I believe is going to do very well over the next 2 years. Well, I hope you do if you watch this channel a lot, right? The group of stocks that I believe is going to do very well over the next 2 years are value stocks and dividend stocks. Right? And the reason being is many of those companies have stories that are going to be very exciting over the next 2 years. They've done major cost-cutting measures. A lot of those companies didn't need to do cost-cutting measures when all the big tech companies did it. All the big tech companies did cost-cutting measures really 2020 at the end of 2022 and into 2023, right? Because their stocks had been leveled. They had to make changes. They did a lot of cost-cutting measures, right? And so that went through, boom. What happened with a lot of the value and dividend stocks, those stocks did not get leveled in the 2022 crash. Many of those stocks were not down 50, 60, 70, 80% like the big tech stocks were, right? So they go through. They didn't really feel like they needed to make any real adjustments to their business models back then, right? And what we saw play out essentially was those business models have now gotten leveled. They've really gotten leveled over the past 12 to 18 months, right? You saw a consumer recession, in my opinion, at least, in regards to consumer. It's leveled so many of those companies, right? Their stock prices have gotten destroyed, and so many of them have announced cost-cutting measures. They really started to announce it at the very end of last year, 2023, but a lot of them have been kind of putting those through this year. And so what you're going to see is a major profit recovery cycle from a lot of those value and dividend stocks, right? Now, additionally, they're likely having savings accounts, CD accounts go lower over the next 12 to 24 months, which means money has to find places to get that yield, which means they're going to likely flood into a lot of those dividend-related stocks, right? Those dividend payers. So that's why I'm very bullish on a lot of these value and dividend stocks that have been beaten down to a pulp recently.
You're looking at the gains this year. You're thinking, okay, maybe we'll have a repeat. Maybe we won't. Do you do anything with that information?
I think you do. We've been aggressively selling calls here. We're trying to synthetically mitigate downside risk, but we're also trying to be more equal weighted. We've let our winners run all year long, and that's been a winning recipe, but I think pigs get fat, hogs get slaughtered. So we're trying to be considerate of some of the non-Mag 7 names we want to own. And if you even look like a day like today, Oracle had a pretty rough earnings, but it still is delivering on the cloud, down 10%. I think that's an opportunity. So I think you have to add to non-Mag 7 names and be considerate in the event you see NVIDIA dip under $130. You're going to see all of these 500 ETFs that own NVIDIA, they're going to have to trim and rebalance. I think that could exaggerate a bit of a pullback here, not more than 5% or 7%, but that will make it more of an acute feeling because we become so acclimated and so used to the market just going up.
Yeah, that's a funny point, that if it falls, they'll have to trim, where you'd think, well, but wait a minute, if it falls, then they're bullish and bad. Andres, same question to you. Given that we don't know exactly what's going to happen next year, what should you do, practically speaking, about it?
Well, if you look at any random day over the last 30 years versus buying at all-time highs, this is a report that JP Morgan put out a couple quarters back. It turns out that buying at all-time highs, if you just look at the data, you actually ended up with better returns than any given day. So I think people shouldn't be afraid to invest because we're near all-time highs. You need to look at the fundamentals. Earnings growth is supposed to be double-digit next year. Multiples are expensive, but there is a momentum. Economically speaking, the Fed is lowering rates. So in essence, if you flip a coin, is the market likely to go up or down? I think it's still up.
Yeah, I mean, I've been in the market 16 years now. I don't even notice if the market's at all-time highs because the market's at all-time highs so often. It's so often. Like the market's at a new all-time high. Really, the only time you don't see an all-time high for quite a while is if you go through a major crash, like great financial crisis, right? Like something, very dramatic where the market's down for many, many years. Other than that, like you see new all-time highs, right? You see new all-time highs and new all-time highs and new all-time highs. So when the majority of your investing life, you're going to be seeing all-time highs. Now, the other interesting thing is with a lot of these value and dividend stocks, this is fascinating because I was just thinking back to the tech stocks. when those stocks all obviously crashed in 2022. When did all those stocks bottom? They all bottomed between September and November, pretty much almost all of them, if you go back and look at a chart of all those stocks, of 2022, right? And what's fascinating is we're getting signs that almost all these value in dividend-related stocks have all bottomed in September and November, right? So a good example is like Estee Lauder, a beaten down dog. This one bottomed right here in November, right? And since then, up in a straight line. No, there's no debating that. Like up in a straight line. If we look at a stock like Celsius, right? Hits this bottom here at $25 in November and now up. If we take a peek at Wynn Resorts. Wynn Resorts hit its lows actually in August. So it was a little premature compared to these other stocks, right? But not by much. I mean, August is right next to September, so Wynn Resorts is pretty darn close. If we look at Nike stock, that was kind of an August and then kind of a double bottom here in November, right? Where's another beaten down one? Isn't there another beaten down one I'm thinking of here? I think there is. I just can't think of it right now. But there's another beaten down dog stock. But a lot of these value and dividend stocks, you're starting to find. Oh, Whirlpool. Whirlpool's the other one I was trying to think about, which isn't one I own right now. It's one I've actually been wanting to buy, but I haven't been able to buy it. Look at this baby. Oh my gosh. So this one actually hit its lows in May. That was off of the back of a bad earnings there, right? And then got down to $93 right here in September. It's $123 today. October got down to $99. Once again, it's $123. So that's another one of those value dividend stocks that's just this rolling, which Whirlpool's basically, I knew that one was going to be a good play. I talked to you guys about that one. I think it was on the main channel, and I knew that one was going to be a good play. And the reason being is, basically, I told you guys, like, people are going to be positioning into Whirlpool before the housing market bottoms, right? And when I say housing market bottoms, it doesn't mean prices bottom. It just means moving activity gets going, right? And so people are going to front run that. And that's exactly what they're doing in Whirlpool. They're front running it. They're bidding that stock up over the past few months. And the reason being is there's a belief that you're going to see more real estate transactions, residential real estate transactions in 2025 and 2026. So they're front running it essentially, right? Which I don't debate that. I think that's probably pretty realistic. If I had to guess where mortgage rates going next year, I'd say probably lower. Same thing for 2026, right? And so therefore, if mortgage rates are going lower, you get more inventory on the market, you can finally get people moving, right? Which is very, very bullish for obviously Whirlpool and Whirlpool's business model, right? And you add on tariffs, from other competitors that maybe produce in other countries, things like that. Like there's a lot to be kind of bullish on, short term in regards to that one. That's why you're seeing so much momentum. All right, let's hear this woman, Elizabeth Burton from Goldman Sachs, about next year.
And strategist at Goldman Sachs Asset Management, back with us at Post 9. It's good to see you.
This is the time of year when everybody's just debating on what's going to happen in 2025, right? This last few weeks of December, like everybody's just debating it, and then like the first week of January, second week of January, everybody's just debating like what's this year going to be like, and then all of a sudden you start having earnings come out toward the back half of January, and then everybody stops debating like what's going to happen for the next upcoming year, because then our focus goes to earnings, and then it's just busy after that.
Good to see you.
I'll just ask you on the broad market. Just because we just had this story about, a deal that is not going to happen. One of the expectations about the new year is that a lot of deals are going to happen. And that's part of the optimism, along with tax cuts and deregulation and everything else. You want to just give us a sort of broad thought on where you think 25 is going to look like?
Sure. So optimism is always great, and we've seen quite a bit of it over the last month. I think the last 4 weeks ending Friday was one of the biggest monthly flows on record, $140 billion into equities that we've seen. So there's clearly a lot of optimism going forward. We think, as you know, our outlook for 2025 at Goldman Sachs is still positive equity returns, but there's a lot of tail risks. There's a lot of places where there can be some stumbles, and we're so concentrated right now, listen, the equity market and so few names, it's not going to be shocking to say that we think you should be broadening out, thinking about diversifying your portfolio now.
I mean, it's interesting because that trade had obviously been working quite well until recently, it feels like. Then the money's been finding a home again in a lot of the mega cap names at the expense of broader parts of the market. Is this just a blip preparing for the end of the year, into the new year? What do you read on that?
I think there is something about going into the end of the year. The last 2 weeks of December, the first 2 weeks of January, historically tend to be really good. for stocks, and a lot of these flows are passive, right? Which means for every dollar you see going into the S&P, 37 cents of that is going into the mega cap names.
Yep.
But we are more constructive actually on the mid cap and small cap names looking into next year. We think there's a lot of room for growth there. There's a lot of quality in the mid cap names. We've said before that we think small cap remains interesting, and we think that story still remains true. And I hear a lot of people saying that, it may not be as cheap as you think, but if you look at on a median PE ratio, small caps and Russell 2000 is what I'm talking about, median, you take out the ones that aren't profitable, it's actually trading at a 23% discount, which on historical average is about a 2% discount.
Do you think there's skepticism in part because we've dialed back our expectations of rate cuts and you need a bunch of rate cuts to make small caps work even better?
That could be part of the issue. I think it's hard just to miss out on FOMO, right? Because if you don't stay invested there, you might think you're getting it wrong. And look, staying invested in growth is part of our outlook, and we certainly like the Mag 7 in addition to the other names. But the Mag 7 we project are only going to outperform the remaining 493 by 7 percentage points next year. That's a pretty small margin to have so much confidence.
You say that next year is going to...
What are some of my favorite small cap stocks? So... Honest HNST is still one of my favorite small cap stocks. That one is $7-something right now, right? I mean, what Carla's done there is just unbelievable in terms of turning that business around. So that remains one of my favorite small cap related companies. Very small market cap on that one, right? Fubo. I mean, if they can just produce a couple quarters here where the losses are very minimal, I think that one's primed to fly major, right? Outside of those two, SoFi is not really technically a small cap stock. They just kind of get grouped into that because they're so small as a financial institution and fintech, to be quite frank, compared to most banks or fintechs, right? So they almost kind of get grouped in, even though they're not technically a small cap. But that one's still very bullish on SoFi, right? That's why I haven't cashed out any shares in the public count. I still got all 3,700 shares I have of that one. So that one definitely comes to mind. I'm trying to think if there's any other small caps that come to mind. Those are probably the main ones. Cheesecake, that one's kind of gets considered a small cap. It's around a $2-something billion market cap there. That one still has tremendous upside for many, many years in regards to that one. That's just a very special 5-10 year story, and so that's why that stock continues to see momentum. I continue to buy the stock. I'm going to probably continue to buy the stock for quite a while into the future. And I'm looking to hold that one for the next 5-10 years because they have multiple kind of growth levers in regards to that company. So, those are just some of the ones that come to mind when I think about small caps. I'm still very bullish on in regards to this market.
About growth assets and diversifiers. What does that mean? When you think diversifiers, what is our viewer supposed to think?
Sure. So I'm saying it's not equities versus bonds. It's growth, which some attribute to equity, but it's a lot of other things too, versus diversifying. So in terms of diversifiers, that could be things like infrastructure, which are, maybe have a 0.6 correlation to equities, but it could also be tail hedges, risk-off strategies, and in this environment, gold and bonds. I think the bond story, while we're constructive on bonds, it's actually one of the biggest changes to our asset allocation is that we're now overweight bonds. It's really in its relative role as a diversifier to your portfolio, not necessarily, a total return story, because we think it's going to be carry driven next year.
So are you thinking a lot about alternatives as part of, and the sort of rebuilding of portfolios in a new political/economic environment?
I don't know if it's so much politically oriented, but rebuilding the alternatives portfolios based on, one, the tail risks you think are coming, and two, what's sort of happened in the private equity and venture markets over the last year. Investors aren't getting their money back. Venture has clearly had some issues, getting funding and returning capital to investors. Mm-hmm. We think growth equity for that reason should be pretty interesting next year. Those sort of check sizes are going to have to come from growth equities. And when you think about that opportunity, there's about 750 unicorns right now, and that's about a 10-year backlog. So those companies are going to need private capital for longer.
They're going to need private capital, which means that at least the IPO pipeline, which is fairly rich,
sure.
A lot of companies are just staying private longer, and they're using the capital that they can get from private equity to
sure.
stay private longer.
Sure.
Is that likely to change, or no?
Once there's more certainty in the market, we hope that will change. But, we've been saying that for a couple of years now, so we need to see additional certainty. And I think one of the things about 2025, there's a lot of different ways things can go, but we should see a pickup in the IPO market for sure. I
think people are looking internationally, too, and trying to figure out what possible tariffs are going to mean on different parts of the country. I've had a lot of people who've loved India over the last 2 years. And now, maybe they still do, and maybe they like it even more.
You know why the IPO market's not, bullish? I'm bullish India long term, very bullish on India long term. That does not mean I want to buy India's stock market index. No. But I am very bullish on India as a country, for the next, I say 10, 20 years, very bullish. Like, most bullish I've been on a country since when I first got in the stock market. I was very bullish on China. No, there was interesting thought there at the end of the video she was bringing up, right? Or they were talking about before they talked about India. Oh, IPOs. So, Goldman Sachs would love more IPOs. But why aren't we seeing a lot of IPOs? Because you look at the financial markets, it's doing well, but where are all the IPOs at? I think there's two reasons you're not seeing a lot of IPOs. First reason is I don't think there's a lot of compelling IPOs out there. Like, usually in the private markets, there's a bunch of very compelling companies that investors like, oh, I can't wait to buy this one. I can't wait to get my hands on this stock. There's hardly anything. Like, only one that comes to mind that I could see investors going crazy for if it went public is what company? SpaceX. That's the only one that I could see like investors being like, oh, I got to buy this. I got to get in this. SpaceX, baby. I'm going to own SpaceX stocks. That's the only one. There's not another company I can think of off the top of my head that I'm like, people would love to buy that. Even OpenAI, because they have Microsoft owns such a huge portion of the company now, I don't even know if people would go that mad about OpenAI. Like, SpaceX is the only slam dunk that I know of right now that I can think of. Like, I'm like, no question. Like, everybody's going to go Google over that. Everybody's going to want to buy at least one share of SpaceX just so he can be a SpaceX shareholder, right? Regardless of what the business model will look like for SpaceX, it would just be an exciting, big deal, right? So I think that holds it back. Additionally, usually you see a lot of IPOs when small caps are running, right? When the Russell's doing great and you get an overall major bull market, which we haven't had an overall major bull market really over the past few years. Look at the Russell on a 3-year basis. Look where it's at. Sleep. It's been asleep, right? So it's basically at the same level it was 3 years ago, if not lower than it was 3 years ago. That's not really a great bull feeling. You need to see a Russell do a huge blow off top, move to all-time highs and then all-time highs on all-time highs, right? To really get people feeling great about IPOs and people willing to take risk and the risk assets. If all you have is just people willing to hide out money in Apple and Google and Meta and Amazon and those sorts of stocks, it doesn't give enough confidence. It doesn't give enough confidence for companies to say, there's a huge appetite for buying anything. Let's go IPO now at this point in time, right? So that's kind of my thought in regards to that. Alrighty, next one up here. Pretty easy for S&P to reach 7,000 by year-end 2025.
Live at Post 9. Welcome back.
Thank you, sir.
You feel pretty good about where we are?
It's hard not to. It's a good year for most sectors. It's a good year for most cap sizes. It's a good year for most asset classes. I don't know why you wouldn't feel pretty good.
I know, but therein lies one of the issues. People say everybody is now too positive, sure. Right? There's on the doorstep of euphoria, and it's knocking pretty hard. Are we there? Close? Not at all?
Listen, I don't think we're on the doorstep of euphoria, but I think there's my view for the better part of a year or two now has just been, let's just acknowledge that things are going pretty well. Corporate profits are doing okay. The economy's holding up. The worries about the consumer consistently have proven false. And in that type of environment, the bias for equities is higher. And then you layer on top of that just the idiosyncratic strength in the AI story and the mega cap tech stocks. I don't think we're on the doorstep of euphoria now.
Evercore ISI today agrees. They say it's not extreme enough. Valuations are stretched. A lot of people think they're stretched. Are they too much? They suggest not enough yet, given the fact that the Fed's cutting and the economy's strong.
Yeah, listen, the only time you really know that valuations are stretched is in the benefit of hindsight.
When it's too late?
When it's too late. Listen, is 22 times forward earnings high? Sure, but it's not as high as 24 or 26 times earnings. And until you go back down to 15, 18 times earnings, you can't look...
Today's is 77? Oh my gosh.
That's too elevated. And my point has just simply been, for the bulk of the year...
Hershey's up. I was thinking about buying Hershey stock recently. I did a whole full dive one night, late night, a few weeks ago on Hershey's. Literally, like I never thought I would even consider buying Hershey's, but I was actually looking into the company recently, and the valuation was very compelling on Hershey's. It was very compelling. And it was after Halloween and whatnot, right? Let me see here. Hershey's, there it is. All right. So, yeah, valuation-wise, so now it's up there. But the forward P at that time, if I recall, in regards to Hershey's, was under 20. And I think that's what really caught my attention I think the forward P was like 19 at that time or something like that, right? And it just caught my attention, and I was like, let me just look at Hershey. It's such a great historical company. They own so many of the most popular chocolate brands and other brands, snack brands out there, right? And so, but interesting. Well, I never bought the stock, but that's interesting to see it's doing well.
Tomorrow not look like today and yesterday. And if the fundamentals behind the AI story are in place, and they still are, the economy is continuing to do well and profit growth is expanding out, I don't know why. Valuation is not a market timing tool, as every strategist will tell you.
So given what I told you is kind of the backdrop, new administration, you got Feds cutting, economy remains strong. What does that mean for where we can go next year? I got a 7,100 price target today from OPI. That sound reasonable?
Yeah, I can get you to 7,000 pretty easy. If you have a perfectly normal December, and we're halfway through the month already, so this is less cool than it would have been 2 weeks ago.
Well, but seasonally is strong to begin with.
It's seasonally strong to begin with. If you have a perfectly normal December, you're going to get to call it 6,200 by the end of the year. And then if you have the 10 to 15% earnings growth that's likely next year, or I should say forecast next year.
So this is pretty interesting because S&P's at, what is S&P at 6,100 right now? Or is it 6,000 on S&P 500? So it's a little over 6,000 right now on the S&P, right? So, I would definitely say analysts are going in more bullish than I've seen them over the past few years. Last year, they went in way too bearish. The previous year, they went insane bearish. Like, wow. Like, a lot of them had basically the S&P 500 going down in 2023. And obviously, it was a banger year, right? And then they went in way too bearish last year. So I think a lot of these guys are scared. I think they're scared. I think that's what's actually going on here. They're freaked out because they're like, we were so wrong the last 2 years. Let's get our price targets up, right? So I think that to me, that's the main reason, my personal opinion, why these guys are putting out all these 6,600 calls and 7,000 calls and 7,000 pluses, because they're like, we don't want to be wrong again.
It's up to 7,000 right there. Now, obviously, it's a little more complicated than that, but no, I don't think 7,000 is a bit of a stretch. And again, we're talking a lot about the rotation. The bias is higher. What do I do in that type of an environment? Is Mag 7 going to continue to lead? My argument has been that there's plenty of other stories going on here beyond Mag 7, and you can see that in the equal weight, the mid caps, etc.
I mean, is 7,000 a kind of baseline look, or is that everything has to go right, or a lot has to go right to get there?
Well, listen, I know for some strategists on the street, it is the bull case is 7,000. I think I'd probably put myself closer to the camp that thinks it's more of a base case.
Wow.
But you say, wow, but again, 10% next year to 11% next year, not particularly off the charts. If I told you we were going to be up another 25 or 30%, then maybe wow.
That's fair.
But I don't think 10% on top of what we've already experienced is. Let me again just be clear here. The Mag 7 is doing great. The net income growth for NVIDIA, 50% for most of those names. Sure. Oracle, Avago's a little better, I think. 10 to 15 to 20%, let's say. Netflix is in that camp as well. But listen, you've got Walmart and Costco doing exceedingly well. You've got the demise of New York City office. Take a look at the charts of SL Green and Vornado. There's all these different stories to which I can point, and then you layer on top of it the rebound in the DocuSign, the Lululemons of the world that just put together pretty good quarters. The dollar stores, which are on the front lines of the tariff war, not terrible. There's plenty of different themes playing out here beyond Mag 7 that support the idea for higher prices.
That's fair, and I mean, look at a lot of these companies, like right, some of these big dogs, Meta, AMD, NVIDIA, right? Next year, earnings per share growth, double digits for Meta. It's just a question of how big a double digits is it. AMD's probably going to be 200%-ish earnings per share growth next year. NVIDIA is going to likely be 50% plus, right? Next year, Meta is going to likely have revenue up 15 to 20%. AMD is probably going to be 25 to 30%, if not over 30%, right? NVIDIA is probably going to be, who knows, it could be another 50%-ish type year, or maybe it's a down year for NVIDIA and they only grow revenue at 30 or 40%. But regardless, the number is going to be huge, right? So the moral of the story is here, like there's still just a lot of growth in a lot of these big tech companies, and that's hard to get the market down, right? I won't be able to react to this last video because my MacBook here is almost dead. So anyways, guys, appreciate you joining me as always. Thanks so much for being here. If you're looking to apply, join my private stock group. Get access to all my premium courses such as Become a Master of Stock Market Millionaire Playbook, Stock Options Mastery, Dividend Investing Mastery, Financial Statements Mastery. If you want access to my Discord chat, all that good stuff, pin comment down there, fill out an application. We'll see if we can get you access to that. And if you want 1000X bundled in, we can bundle that in as well. Much love and have a great day.